Get ready now. The majority of people will lose everything because to what is to come. The majority of people are unprepared for what is about to happen. They believe that their employment or financial worth will be sufficient to shield them from this impending catastrophe. The majority of individuals are unaware of how important it is to find alternative ways to develop their money in order to maintain themselves and their families because they believe that cash is a long-term answer for survival. Alternatively, cash might not be the ideal option for an investment. Inflation, shaky economic conditions, unforeseen political developments, economic downturns, wars, financial collapses, bad monetary policies, and other non-monetary causes all work to devalue the dollar. There is always a chance that something could go wrong at any time, regardless of how old or young you are. Preparation is the key to avoiding tragedy, but do you know how or what to prepare for? The majority of people think that money is secure. Contrary to popular assumption, it is the least secure since there isn't enough volatility in it. We created the Bretton Woods monetary system in 1944, which is a new monetary system. Then, in 1945, we created a new international order that was essentially characterized by an American world order and a bull market for equities. Additionally, we are used to a cycle in which the central bank may encourage debt expansion whenever there is an economic slowdown, which raises demand. And all three of the cycle's phases experience this. Usually, interest rates come first. The economy grows as interest rates are decreased, but when they reach zero, as they were during the 1932 debt crisis, the economy stagnates. The second type of monetary policy is when central banks issue money and add liquidity by purchasing financial assets. Such purchases cause bond sellers to collect cash, and the cycle continues as they go on to buy other financial assets. But only twice have these circumstances actually happened, in 1929 to 1932 and 2008 to 2009. Zero interest rates, money creation, and monetization, however, can only get you so far. Then there is Monetary Policy 3, which suggests that money does not reach the populace and flow to all of the appropriate areas. In other words, it's a coordination of monetary and fiscal policies in which the central bank makes a variety of asset purchases that create liquidity and have the effect of buying and monetizing government debt. And the growth that is currently propelling the market and economy is in its late cycle. For instance, the Federal Reserve and the government provide today's market liquidity, which has a big impact on the value of money. What is the worth of money, though? What happens to it? A cash investment will not be profitable. In other words, the environment affects everything. Isn't it an interesting world when interest rates are zero or negative if you only take cash into account when comparing the returns of different asset classes? Then, there is the desire to create a spread with high liquidity and lower short-term rates than long-term rates. This market is created by the central bank, thus it necessitates a storehouse of wealth, which is clear in all asset classes when we look at the market today. Additionally, this has important geopolitical ramifications because it will be crucial to comprehend how the distribution of wealth and bills will influence taxation and other policies as we move towards a future where the wealth gap and political divide are both common. This closely mirrors the 1930s, when overall inflation did not immediately rise. Instead of creating deflationary forces, it slowly depreciates currencies. Early in the 1930s, the value of all fiat currencies decreased in proportion to gold. Additionally, without a noticeable degree of inflation, we typically see the same kind of phenomenon nowadays. It looks into various financial institutions and stock markets, concentrating on certain stock classes that are similar to those in 1933. Franklin Roosevelt broke the link with gold-printed money in March 1933 and made money readily available at the same moment the stock market reached its low point. The Federal Reserve and the Treasury carried out a similar action on April 9th. The outcome is a reflection that affects other assets, like stocks and others, and the consequences of doing nothing would be intolerable. Each person, corporation, and government has a specific amount of income, spending, and balance sheets when it comes to the wealth gap and other challenges. Defaults and restructurings happen when revenue is insufficient compared to costs, the balance sheet is insufficient, or revenue decreases to unacceptably low levels. Both the general populace and many corporations can attest to this. History has repeatedly demonstrated that severe economic downturns lead to the development of weak monetary policies, as well as major wealth disparities, political divides, and a higher likelihood of internal conflict. As a result, internal disagreements over how to share the wealth pie is typical. Changes in tax laws and other regulations will eventually result from the dynamic we are currently watching. Additionally, the atmosphere for investing will be very different from what it was in the past, since the market's liquidity is driving all market excess returns to decline and become small in comparison to the absurdly low cash rates. Think of it as a zero and very low returning asset environment. Negative real yields are hence detrimental to cash. Effective diversification requires going beyond the traditional 60-40 stock-bond mix, or even the same countries, broadening that diversification to include assets that might seem unusual in your portfolio, such as some gold or inflation index bonds, and considering the currency exposure, security, and exposure as dissimilar. The majority of people mistakenly believe that cash is the least secure form of payment. The large cash production is the only reason it is not volatile, and the real return is negative. It is a tax that costs you money in the form of a possible 8% yearly financial loss. You must thus diversify as much as you can and alter the way you perceive risk. The value of passive classes makes it possible to diversify without reducing predicted returns. Second, on top of that strategic, well-diversified portfolio, any tactical bets you make from them should have a high degree of diversification. Additionally, since circumstances change in unforeseen ways, deviating liquidity is more crucial than ever. Consider the companies that, at first appearance, seem to be successful. In the future, it will be crucial to be able to reconstruct, increase portfolio diversity, and place a wide range of bets while remaining conservative. Although we take into account these conventional asset classes, we neglect to examine the value of money, what will happen when the value is printed, and how to diversify. These are the factors that must be taken into account, just as they were important before 1945. What's interesting about it is how current interest rates are seen. Assume that bonds have a zero anticipated return. It is clear that their ability to rise or fall in valuation is limited, or that, in order to have an impact, one must use them to a great extent, which is not ideal. History has shown, however, that when central banks choose that route, they will issue money and raise the value of it. And the main issue in a depression is fundamentally a liquidity issue with debt. Reflection will therefore be an option even if interest rates rise, as they are currently doing. It's critical to realize that asset diversification has altered in nature. Similar to how, since reflection will always occur, other assets will help you profit from it. And because of this, you can see that all currencies have depreciated in value or even vanished over time, especially during periods when we're experiencing a new paradigm.